Hello, everyone, and welcome back. I'm Anthony Newgosh, and thanks for joining us for this latest BKL webinar today covering tax issues amid rising interest rates. And this is our first webinar since BKL became part of the CPBE family, which we're also very excited about. So welcome to our CPBE colleagues as well. Well, today I'm delighted to be joined by someone, not just a colleague, a friend I'd like to think about, Helena Kangsula, who's joined us recently to further strengthen our tax consulting team here at BKL. Welcome, Helena.
Thank you, Tony.
So, Helena, rising interest rates, we need to look at the corporate debt rules, we need to look at the deductibility of interest rules generally for companies. So, what are we going to be covering today?
Well, we'll be focusing on the corporate interest restriction rules, which broadly affect companies with net interest above 2 million or groups. What we're finding is a lot more companies are affected by these rules as a result of the rise in interest rates. But because a lot of the interest rules are very interconnected, we also have to cover other different types of rules which could cause there to be adjustments. We're also going to be looking at withholding tax, which is another hot topic at the moment.
So I think it's fair to say we've bitten off plenty today. I think the legislation is 150 pages on the corporate interest restriction rules alone. So we will just look in overview at the connected company rules, these quite nasty deemed release rules for companies, unallowable purposes, and the hybrid interest rules as well, or the hybrid instruments rules, I should say. And perhaps that's something we'll revisit on future webinars. But let's just sort of put this in context of where we currently are, not so much from a tax perspective, but more economically.
But this is the chart of the changes in the Bank of England bank rate really since 2008. So Tony, I think the last time we shared an office, there was a similar crash, but adjustment to interest rates, but downwards. And then obviously we've had this relatively long period of lower interest rates. Suddenly this shock, and this is having quite a big impact, certainly on companies and other clients that have to pay large interest rates.
Yep, so sort of 2007-8, our old friend, the credit crunch.
Yep.
Then interest rates have flatlined, and now, as you can see from that chart, a very, very steep increase of late. I mean, that's, I'm sure, of no surprise to our lovely listeners, but how's that impacted from a tax perspective?
Well, HMRC have not been shy about also increasing their interest rates, which they charge. So here we're focusing on corporation tax. The rate has increased to 7.5%. Actually, they are paying 4% on normal corporation tax overpaid. So that's tax due on the normal 9-month date after the end of the accounting period. For companies that are in instalment payment, the rate is slightly lower, 6%, but actually if companies have overpaid their instalment tax, they get the interest receivable, or the credit interest, is for 4.75%, which is not bad really.
They're the best bankers in town, really, aren't they? And I was very
be.
careful about how I said that. Indeed. So yeah, I mean, I think one of the key messages is in the past, we've always taken the view that any interest you have to pay should you underpay your instalments is frankly not worth worrying about when interest rates were so low. Now, 6%, albeit, as we've said there, it is tax deductible, or interest you are due from HMRC is taxable for corporation tax. 6%, now it's certainly worth thinking about, isn't it? And people might want to be a little bit more careful with their calculations. It's interesting to compare this, isn't it? Beneficial loans and the official rate of interest is, I believe now, it's just crept up to 2.25%. So there's a bit of a lag there. So again, HMRC being pretty generous, and it's not often you'll hear us say that, but there you go. So,
but just in terms of instalment payments, just make the small point here that you know, if a company was large in the prior year, they may well be large in this year. There's also a grace period which operates, which often gets overlooked. And and therefore you can find you just inadvertently within the instalment payment regime. It's worth checking for December year ends, actually December 2023, because the first instalment would have been due on the 14th of July. So,
and look, again, we've not got time to cover this in detail, but we might just flag up, of course, with corporation tax rates going up to 25%, the instalments will be higher, and we've got the change from 51% group companies to associated companies as well taking effect now. So, all right, that sets the scene and just highlights why this might be relevant. Let's move on and talk about a very brief overview as the treatment of corporate debt generally, Helena.
Well, it just generally follows the accounts. We don't have this normal distinction which you see with expenditure of whether it's capital or revenue. We're often just looking at as to whether a loan or a similar debit is trade related or not, but the rules are very different to those for individuals. And on top of that, once we've kind of got the interest from the accounts, there may well be some statutory exceptions or specific rules on how interest is relieved. So we mentioned a few of them here. I know we're going to mention a few of them towards the end of this presentation, but really focusing on corporate interest restriction, and that comes in last in this list because that we apply those rules after we've applied all these other different rules. So, for example, transfer pricing or just excessive interest generally, even if a company isn't that large, if an adjustment is required, that will be done before we start worrying about the corporate interest restriction rules.
So, as you said, we'll touch very briefly on some of these other points towards the end of the presentation, but just to reiterate, as you say, we deal with those adjustments first, and then we decide if and how the corporate interest rules should apply. So let's strap ourselves in and let's have an overview of the corporate interest restriction rules. Helena, take it away.
Okay, so the rules have applied since the 1st of April 2017. I've been recently sat on a working committee with HMRC, and it's fair to say they are a little bit frustrated that businesses have not yet got to grips with some of the intricacies of the rules. As Tony mentioned, legislation is very lengthy. Actually, when they published their guidance initially, it was 577 pages long, and there have been subsequent changes. But broadly, the rules will apply to a standalone company or a group which has net UK interest expense over 2 million. And like we mentioned in the previous slide, that's the net interest after making any sort of adjustment that is required.
Now, I mean, this seems quite generous, 2 million. I'm just reading some of my old notes about, well, if you're talking about a property group where these rules can be relevant, at a 4% interest rate, they could borrow up to £50 million before they hit that £2 million threshold. But the point we've just made is with interest rates increasing so rapidly, it's going to drag a lot more people into this, isn't it?
Yeah. And particularly, companies that, have quite lumpy profit margins each year. Just there can be things that we need to think about and plan for.
Yeah.
But like you say, I mean, a lot more companies are being dragged into this. Actually, any kind of tax measure which requires us to look at size, there will be other target turnovers, etc., where companies will be affected.
And it's something we need to look at every year. But what's quite unusual about this is we do the calculations at a group level. If there is a restriction, then that gets pushed down to a company level, doesn't it? So it doesn't sit very comfortably. When I was in tax school in my shorts, we were always taught you look at companies individually. That's where you do the calculation. So anyway, we'll explore that a little bit further as we go through this presentation.
It does require us to have a very good overview of a group, which if you've got a worldwide group, can obviously cause some sensitivities and complexities to proceedings.
Indeed. Okay. If we're all sitting comfortably then, Helena,
right,
let's take it away and start with how we approach, how we calculate, how we apply these corporate interest restriction rules.
Right, so there are basically 7 or 8 steps. And what I would say is there are a lot of abbreviations, and I think that causes much of the headache associated with these rules. It's really easy to get mixed up.
They're all very similar, aren't they?
Yeah.
Yeah. So.
And that's the problem, and but they're each slightly different as well in terms of what's involved. So step 1 really is identifying what is the group. In most cases, that'll be completely obvious. You know, you've got a parent company and its subsidiaries. There are some rules around where there is an other type of entity. So, for example, a partnership. What's the group there? You know, again, quite an unusual situation, but it looks at the ownership of that partnership, for example. And there, where we have a group which might be held as an investment, say there's a sort of fund structure and it's measured using fair value accounting, we may not have to look up through to the parent that holds the company or the group as an investment, but obviously the subgroup may itself form a corporate interest restriction group. So we just need to be a bit careful. In most cases, it will be completely obvious. What we can also have is a standalone company.
Yeah, it's slightly, yeah. And albeit, as we'll see when we go through the calculations, with a standalone company, it's unlikely you're going to have adjustments, I suspect. But you can, it can happen, but okay. But look, the takeaway, the starting point is get yourself a good structure diagram. I think that's the moral of the story. And I think the last point you've made there is we've now got non-resident landlord companies within the scope of corporation tax. We do have to take those into account for these purposes.
Yeah.
So that's our group. That's what we have to identify. The one thing I should have said is if any of you have any questions, do feel free to type away. We'll do our best to answer those either as we go along, or if we don't get the time, or we need to go away and look at it, we'll do our best, and we will be circulating copies of the slide and a link to a recording of the webinar later. So as I say, as always, very grateful for your thoughts, comments. Feel free to type away. Okay, so that's step 1. So far, so good.
Yeah.
Nothing in most cases that shouldn't cause too much difficulty. But get yourself a group structure chart.
So step 2, equally, I'd say we're probably on safe ground here as well.
We've got our first acronym here, though.
Yeah, it's the ANTI, so the aggregate net tax. Oh, I've forgotten the tax there. Interest expense of the UK group companies. So effectively, any company that is within the charge to corporation tax, you have a look at what is in its tax comp as the deductible amount of interest for that period, and that is brought into the calculation. Now it's a net figure, so you're netting off any interest income.
It's the tax deductible interest, yeah?
Yeah.
So if
net
amount, I mean, let's say we'll touch upon the 12-month rule, but if whatever interest is deferred, tax relief, go on the tax number. Okay, I'm with you.
And there are some certain exclusions. We don't include foreign exchange, and that's the main one where we normally have to be a little bit careful, because for other purposes, foreign exchange is treated as is within the loan relationship. And so really what we're deducting here is it's not just interest. Interest is quite a broad term, but we just use it for ease. It'll include things like professional fees to do with the raising of loan finance, bank charges, interest on finance.
It certainly was 307. I'm not sure if it still is, but those sort of incidental costs that are treated as loan relationship debits and credits, whether, as you say, they're trade or non-trade.
Yep. And you can just see in this example, obviously, if that non-UK subsidiary, was a non-resident landlord, you probably bring that in. But just in this example, we've got an aggregate net tax interest expense of 4 million. So we're clearly over the 2 million de minimis amount.
Okay.
So we may need to restrict.
And it's a may, isn't it?
Mm-hmm.
If it's under 2 million, are we home and dry?
In most cases, yes. There are sort of outlier cases when you may need to just have a look and think about possibly submitting an abbreviated interest return, but we'll be sort of touching on that as we go through this, because it would be unusual.
All right. So that's step 2. Broadly calculate your net tax interest expense of the UK group companies. And just to reiterate the point, we do net off any interest receivable for these purposes. And we do that on a company by company basis and add it all up?
Exactly.
Okay.
And the software will often pull out these figures and push them into sort of fairly tax return, the corporate interest restriction return. But
all right. So all right, let's move on now to step 3, where we have a few adjustments to make. So, or a few calculations to do, I should say.
Okay, so if you've looked at the interest restriction rules before, you may be aware that the next step looks at EBITDA, because the basic rule is that our interest deductions that we can claim are 30% of tax EBITDA. So this next step is relatively straightforward because the software will usually do it as well, but effectively we're starting at our taxable profits, not our PBT, and we add back any interest receivable, group relief, brought forward losses, etc. And really we're just trying to get to a measure of EBITDA which reflects UK tax principles. So your sort of permanent differences would be included in there, things like entertaining and the like.
Yeah, so we're just stripping out anything that's your interest, tax, depreciation, etc., etc. Capital allowances are included there, as you've highlighted. So again, as you say, I mean, I suppose there's various ways you could get to the right number, but that's probably the simplest way and the way most pieces of software will do it. So take your taxable profits as adjusted, as we say, under UK principles, and then back out what shouldn't be included to get you to tax EBITDA. And we do that for each company again, and add them all up. Okay. So that's step 3. Now, I think it gets a little bit trickier, doesn't it?
Yeah, because this is the point at which we suddenly start getting a lot of abbreviations within one step.
Okay, so quite a bit on this slide, Helen. I don't know if I'm more in awe at your technical knowledge of these rules or your Excel skills, but very impressive.
We're calculating here what we call the interest allowance. Now, in most cases, this will be exactly the same as something called the basic interest allowance. We can probably all completely ignore the notes right at the bottom left, but it's just that if for any reason there was net income in the UK,
all right, that's going
to
be might be a
carry. So interest allowance, basic interest allowance, same thing. And I think again this is probably the point that most people are familiar with. Fixed rate method. This is the kind of 30% rule. We take our aggregate UK tax EBITDA that we calculated in the second step, times it by 30, and then we look at a measure of the group's external funding. So we look at the group as a whole, not just the UK companies. And we also look at something called the excess debt cap, which I will come on to, but effectively we're just taking the lower of these two numbers. So if for any reason, 30% of UK tax EBITDA was a lot bigger than the group's external funding, then there would be a restriction based on the external funding.
This is the point I think we touched on before. This is saying, look, if you start trying to shove debt into your UK group that's higher than what the group as a whole has borrowed, then we're not having that. So, we do have, transfer pricing, etc., which may, as we said, you'd apply first. But this is saying, notwithstanding that, we don't like it when people try and shovel as much debt as possible into the UK.
Yeah, and you do have to apply the transfer pricing first. I know a lot of people go, well, we've got restriction because of the corporate interest restriction, but you know, that would affect the disallowable amounts carried forward. So it is relevant. We do need to do everything properly. There is an election that we can do for very heavily geared groups, because if you look at the example here, if on a consolidated basis, the level of gearing was a lot more than sort of a 30% ratio, we can make an election and apply that percentage to the UK group, but again subject to the external level of debt that there is.
So this is going to be relevant where the group is highly geared.
Yeah.
Because that 30%, I suppose most would say it's not outrageous, but it's a little bit arbitrary, isn't it? So be it. And it's interesting because this goes back to the old debt cap rules we had, doesn't it? It's sort of son of that some of you may remember fondly. So under both methods, as we say, we need to do some pretty detailed calculations here, but we do have a choice. Just, Helena, how do we make this election? When do we need to make this election?
Well, it's made in the return. Now we'll go on to the due dates for the return, but effectively there's a sort of box that you need to tick, and you opt for that. It's not some of the elections that we make are irrevocable, whereas this one's quite good in the sense that each year you can decide to make it, but generally you'd elect within 12 months of the group's year end and in the return.
Okay, so now we've talked about our net interest expense of the worldwide group, which again, it's important. You know, this raises various sort of practical points, isn't it? You know, we may have a good handle on our UK accounts. We've got to derive these figures from the worldwide group, but we need to just describe a little bit what we mean by ANGI and our is it Quanji?
Quanji, I say.
Okay, it's worth a few Scrabble points, though, I suspect. Let's just talk us through, Helena, how we get to our ANGI.
Well, from the consolidated accounts, basically, we don't have to kind of go away and get all the tax comps for all the overseas companies or anything like that. We basically pull out the accounts and then do a similar calculation to the one that we do for the ante. However, there are certain adjustments that we have to make, and those are set out in the legislation, but broadly, I mean, the most typical one is equity, which is treated as debt in the account. So something that for UK purposes we wouldn't get a deduction for. And the probably nasty one really is that in certain circumstances, interest which has been rolled into an asset, it's actually recognised for these purposes at the point at which it is capitalised,
right,
rather than when it's debited to the P&L.
Mm-hmm.
So there can be a mismatch between what we do for UK tax purposes and what's in the account, but there's certain elections that we can make that helps match all of that up. Reality is it's probably going to affect UK only groups or standalone UK companies. So this is why the rules are a little bit unfair. I think they're actually more favourable in some respects to worldwide groups. But anyway.
Okay, so in theory, as you say, grab the worldwide consolidated accounts. There you go. Have a look at your interest income and your interest expense. We're done. But we do need to be careful where there are these potential mismatches, be it capitalised interest, as you say, equity treated as debt, etc., etc. So again, it's one of these things. It can't be rushed, I think, is what we're trying to say. There are points that could be easily missed. You might, in an ideal world, you won't have any of these adjustments, but you do need to be sure and have a good handle on how the worldwide group has accounted for various interest-like expenses. So that's our ANGI. Just remind me, Helen, the Quanji. What's the difference between the two?
Well, starting point is basically the ANGI number.
Yeah.
Okay. And so remember, the point of this election is if we are really heavily geared, it might be worthwhile making this election.
Yeah.
However, what you strip out of that ANGI number to get to this QNGI is related party debt, and that is quite broadly defined. So we need to look at whether a related party might have guaranteed a third party loan. As ever, the devil's in the detail. Actually, the revenue manuals are really, really good on all of this stuff.
That's twice we've complimented the revenue today.
I know.
It's outrageous.
It is. But from this figure, we've got this QNGI figure, and then what we need to also do is now look at group EBITDA for these purposes. Again, there's various, that's taken from the consolidated accounts. There's various adjustments that you have to do. I mean, the one that mainly comes to mind is to do with capital gains.
Right.
There's an adjustment that you need to do just to make sure that what you're comparing like with like when you're sort of looking at UK and then your worldwide.
All right. So just again, be careful. In many cases, there may be no difference between your ANGI and your QNGI. Have I got that right now?
Yeah.
My northern dulcet tones. But do be aware if there's any related party debt, there could be adjustments there. So let's go back to where we were. We were just starting to look at the group ratio method, the alternative method where we're highly geared. Anything to add there, Helena?
Just that when we're comparing, say, the 30% with the ANGI, there's something else that we need to add on to that ANGI, which is the excess debt cap. But again, we'll look at that because I think that's straying into parts of the legislation we'd rather not look at, but can be quite helpful nevertheless.
We'll see how brave we are. Hey, so okay, there's a fair amount of information gathering, and you say in theory the calculations aren't that complicated, are they? But
no.
You've just got to be careful. You do take into account all these little nuances we've talked about. So those are our two methods. Now we have to calculate the interest capacity and what's disallowed. What's the story here, HK?
So again, this is another example of we've got these abbreviations that are very similar to the other abbreviations. Interest capacity is really looking at that basic or the interest allowance, which we said would be very similar or the same as the basic interest allowance from step, was it 3?
I think so.
And then adding on any brought forward interest allowance, and that is, and I'll go on to show you what that might look like. And then taking that number, and that typically will be higher than 2 million. But if that figure was, if the higher number was 2 million, then that is the maximum interest capacity.
All right, and we'll talk through some examples that I think hopefully will clarify and explain that a little bit further on the next slide. But we work out our interest capacity, as you said, and then we have to work out what's disallowable, don't we?
So you take your aggregate net tax interest expense broadly and take off the interest capacity.
All right, but again, we'll look at that. If we do have a disallowance, though, then that has to be pushed down to the UK companies, those with net UK interest expense, which is another little story. But let's try and just explain what we mean by some numbers here, Helena.
So this is just looking at this point mainly to do with the interest allowance. At the top, we've got aggregate net tax interest expense from our step 2. What I'm assuming here, just by the way, is that we've got the same year but just slightly different numbers just to show you how they operate. So say the net tax interest expense was 4 million. Our basic interest allowance, which we said is probably the same as the interest allowance, is 3. Our interest cover is 3 because we haven't got any brought forward unused interest allowance. So the amount we disallow is 1.
Yeah.
Compare that with the situation where our aggregate net tax interest expense was.
Well, this is the following year, isn't it, Helena? We're talking about now.
No, I'm literally doing comparison just to say.
All right.
So, sorry, it does say 2022 on there, but I will change that. So we've got some unused capacity that we can carry forward to the next year. So to 2022. Just in red, one thing I think people get confused with, and is to do with, well, what if I say, for example, had interest expense of 300,000, so that I'm not using my 2 million? Is there anything that I can do to maybe carry forward that de minimis, the difference between the de minimis amount? You can't bank that in any way, which is unfortunate. So if, you know, in a future period you think you might have a disallowance.
So there are certain carry forwards that we will touch upon.
Yeah. So if you go to the next slide, this is just, it's just really a picture just showing you really with this if we had unused interest allowance, really how it might operate. So the first year we were quite heavily geared, we're well above the interest allowance amount, but then the following year actually the interest payable goes right down and we've got a little bit of capacity, so we could potentially sort of access part of the brought forward disallowed amount. That 20. Similarly, in years 3 and 4, we've got capacity. Year 5, just to clarify, what I'm trying to say here is that we still, you know, the interest for the year is still 30, but if the interest had been higher, actually we do here have some interest allowance that we could have potentially accessed. As it is, we just carry that amount forward. You can only carry forward unused interest allowance for 5 years, which is why some of the deadlines and time limits for making certain elections and filing certain returns are refer to a 5-year period. But, you know, there is scope to use brought forward disallowance. I would say most cases we don't really see much usage of the disallowance. So in terms of, is it an asset of the company for the purpose of deferred tax? Probably not, but you can, where profits are a bit more lumpy, there may be some scope to access that brought forward disallowance.
Okay, all right, so let's have a look at another calculation here just to illustrate some of the points we talked about and this excess debt cap that you referred to earlier, Helena.
Yeah, so if you remember step 4, I'm not going to talk through all the numbers, but basically step 4, we saw that our basic interest allowance, which we said was very similar to our interest allowance, etc. We looked at the lower of, so this example, I'm just using the fixed rate method, the lower of 30% times the tax EBITDA and the ANGI plus the excess debt cap brought forward. So in this example, what we're effectively saying, in 2021, we have none of this thing we're calling the excess debt cap brought forward. So we're just doing the normal comparison. Then we're going down to our disallowed amount, etc. But this is where step 8 comes in. It's, well, what can we carry forward to the next year? And there's another of these comparisons. We take the difference between the aggregate net tax interest expense, which is from the group figures. We take off the 30% tax EBITDA. That gives us a number, and we compare that with what we've disallowed and the brought forward debt cap from the prior year. Sorry, something's hidden in that schedule. So the lower number, that 5 million at the bottom, is what we can take forward into the next year. And here in this example, effectively what it's saying is, if we didn't have that ability to use that brought forward excess debt cap figure actually our basic interest allowance would be 21 million, but instead of which we're now able to claim a deduction of 23 million here. Yeah,
that's the point, and that's why at the bottom the carry forward has gone down by 2 million, isn't it?
Yeah, we
So
finally got it.
yeah, we can carry it forward 1 year, can't we? And listen, it's not easy, this, is it?
No.
You know, it's one to almost sleep on, but that's what the excess debt cap. So again, but it's helpful here, isn't it? It's giving us an extra £2 million worth of relief.
Yeah.
And that's why the carry forward is correspondingly reduced, as we saw. So probably want to work through quite slowly that slide, but I think it does highlight how complicated the regime is, albeit, you know, many of the principles I think seem relatively straightforward and, dare I say, fair. So that's excess debt cap and how it may be used. Taking a step back now, Helena, we've now got disallowances. How do we allocate those?
Well, the first advice would be to make sure that the group complies with the various reporting rules. I mentioned part of this working committee that I'd been sat on. A lot of the frustration is the fact that groups, companies aren't realising they're within the scope of the rules and trying to nominate a reporting company, etc. If you don't nominate a company to report on behalf of the group, you can only allocate the interest pro rata to the net interest expense, rather than choosing how to allocate the disallowance.
Yeah.
So it's helpful if you are able to nominate a reporting company and file the returns, because you know, an example would be if a company had a lot of losses, you may well want to allocate your disallowance against that company, etc. It may be possible to do some planning and allocate to a company that may have scope to use that disallowance in future for whatever reason. Maybe we are expecting a large a large level of profits, etc.
Yeah, for property companies we know is going to make a gain in the next few years.
I mean,
that might be reason.
It's difficult to model.
Have you seen HMRC raise the topic of penalties for this? I know you're saying they're getting frustrated.
There are sort of fixed penalties for lateness, and I have seen them try and levy those.
It seems to me, you know, the stick would be, you know, you've not filed the returns, you've not complied with these rules, you've been careless. Let's talk tax geared penalties, as we're seeing in other areas of tax, which are currently the bane of my life, as it were. But that, I suppose, could follow, couldn't it?
Yeah, I mean, look, when we first started discussing the fairly minor changes and tweaks actually under FA 2023, it's just to improve how the legislation works. But they were sort of saying if they were asked to nominate a company late, outside the normal 12-month window, then there wouldn't be this flexibility to decide how interest could be allocated across the group. Actually, reading their manuals, there does seem to be some option, provided that, you know, all the companies are what we call consenting, etc. So that's quite handy. Other recommendations.
Oh, wrong way. Sorry. Yep.
We got this in the right.
So then we're talking about elections, Helena.
Yeah. So obviously there's the standard. Do we opt for the group ratio method or the fixed ratio method? You can choose from period to period what
point,
you do there.
Not,
so that one's good. I talked a little bit about capitalised interest and the problem there, that there can be a mismatch. I would recommend, if you've got property companies that have property development companies that have a lot of capitalised interest that's rolled up into stock, you maybe look at the examples in the manuals, because certainly for UK groups, what you can find is, because of this mismatch, it means that it can restrict the levels of deductions when the property is sold, because the cap already includes all the interest has been sort of calculated in previous periods. So they're just, again, you need to sort of run through the maths a little bit, but there is opportunity to make what we call an interest allowance alternative calculation election. This is irrevocable. So it doesn't just cover capitalised interest, it covers other areas where we might have timing differences. I think the one that comes to mind, I think, is pension contributions. It's a while since I've looked at it, but that's, again, be careful, because this is irrevocable. It's made in the return. Joint venture election is often what you find is in consolidated company accounts. You know, we won't separately split out what the interest is for a joint venture. It'll all be just thrown into the profits. So this election just effectively lets you strip out the results for that joint venture, because otherwise you've got a larger EBITDA but no interest expense, and it just helps with doing that group ratio method. It's okay. So public infrastructure election, this is another one we come across, but again needs a little bit of care. Often we find that running through the maths, the group ratio method probably gets you to a similar result, but effectively it allows companies to claim a full deduction for third-party interest. And it relates to specific companies groups that have qualifying infrastructure businesses. Now that the rules were extended to include some UK property businesses. Related party debt you won't get a full deduction for, and in fact the way the rules work, they then assume your EBITDA is nil. So you can see that effectively you can get to a similar position as you would do under the group ratio method. I think a lot of companies also defer making that election because you have to, once it's made, well, it's an in-year election, so if you wanted to go into this regime for 2023, you'd need to make it during 2023. You can't make it 12 months after or anything like that. But also once you're in for 5 accounting periods. You can then come out, but then you can't go in again. It can cause problems on a third-party disposal as well, where a purchaser potentially has a lot of related party debt rather than is externally financed, so it might involve a little bit of restructuring depending on what the business is.
So plenty to think about there. All right, let's just finish off this particular section by talking about the administration of this regime, Helena, what we need to do, etc., etc.
So again, usually it's advisable to appoint a reporting company, and that must be done within 12 months of the period of account to which it relates. And you need the consent of, I think it's about 50% of the companies. And an interest restriction return then is submitted to HMRC. The general filing deadline is 12 months from the end of the period of account, just like any normal tax return. You can submit an abbreviated interest restriction return, and that would apply where the group clearly does not need to apply any kind of restriction, whether it's you can elect on that return also to use the group ratio method, but if it was a large worldwide group and the level of interest in the UK was particularly low, you could do that. However, what you can't do is carry forward the interest allowance, so there is scope then to submit a full interest restriction return.
Okay, so
and
again,
replace that. But
something to be thought about, isn't it? And finally,
so that's to do with revisions. So you've got 36 months from the end of the period in which to revise it. That obviously has knock-on effects for the individual tax comps. So there's various deadlines that apply there. And if you've got things like group relief, etc., you just need to watch watch out there, because you might have to use one of HMRC's statements of practice in order to file something late. So it's not ideal, but look, if you're filing a return, a full return in place for an abbreviated return, certain time limits are extended to 5 years, and that's because of this interest allowance carry forward point, which we've referred to before. And again, it might just be advantageous for a single group company, so a standalone UK company, to file a return if it was felt that there was some kind of reactivation that could happen in the future.
So if you think you may fall within the regime in the future, in the next 5 years, then certainly it's worth thinking about. Okay, so a lot to think about there. You know, for some groups it may be pretty straightforward, but there's a lot of detail in there, isn't there?
There is, but again, it's the terminology, isn't it, Tony?
And it's unfortunately, it's just one of these things where you've just got to get your hands dirty, I suspect. Where can people get help, Helena, if they do need help on this? Apart from our good selves, of course.
HMRC manuals, like I said, the corporate finance manual.
Yeah.
It's around 9,000, 90,000, I think. There are various, I mean, the tax software again should help in most cases.
Yeah, I mean, Alpha Tax is pretty good that we use, isn't it? Within the group module, if you've got access to the group module, it will do these calculations for you, won't you? As always, one can't just solely rely on the software, as it were, but it will hold your hand through it. And in our experience, it's rarely wrong. So it is very much a good source, and will give you a lot of comfort. If it comes out and tells you what your adjustments are, I think you can place a certain amount of reliance, as long as obviously you've put the right data in there. Okay, so that's the corporate interest restriction in overview. Well done, Helena. Thank you for that. We're going to give Helena a bit of a lie down now, and I'll talk you through some of the other corporate tax adjustments that we mentioned. Of course, this is just an overview, but we just wanted to make sure. It's very easy, isn't it? You can focus on one adjustment and forget there are other things that need to be thought about as well. So we just wanted to flag up some of these quickly. So I'll talk you through these, and Helena will, I'm sure, add her pearls of wisdom as we go along. So a lot of this is building upon the loan relationship rules that we've talked about. Broadly, follow the accounts unless there's a tax rule to the contrary. And it's been mirrored in other rules, hasn't it? Intangible assets now is built upon that same framework. It kind of makes sense. Now, there are special rules for connected companies. What do we mean by connected companies? Companies that are under the control of the same person, or one of the companies controls the other. And there's always been this slight doubt with the loan relationship rules. Can you read person as persons under the Interpretation Act of 1978, I think it is? Unusually under these rules, we don't take into the account of associates, family members, people you're in partnership with, etc., etc. And there is some doubt here. I think the revenues view is you can read it in the plural if those persons act in concert together. So it's not entirely satisfactory. If Helena and I own 50% each of company A and 50% each of company B, it's not entirely clear whether or not those two companies are connected for these purposes. But there you go. Why are we talking about this? We'll see it's relevant in respect of impairments and loan waivers. There are also, just for completeness, rules about where you have a major interest, 40% each. Is two people with 40% each, I think, isn't it, Helena? It's only really relevant in the context of the late interest rules now. Now, those have been rowed back. You could have a deferral of tax relief until payment if interest wasn't settled within 12 months of the accounting reference date. So that was a departure from just follow the accruals principle in the accounts. It now really only applies broadly to participators rather than fellow group companies in general terms. And it depends whether the other party, if it's a company, is relevant in a non-tax haven or not. But section 376, I think, is CTA 2009. I think one for another day. Let's just focus on, two companies, are they connected for these purposes? Why are we talking about this? Well, broadly, if you release a debt between connected companies or you provide against a debt between connected companies, you don't get relief. So it's a departure from our accruals concept and follow the accounts. A couple of exceptions. One, if the creditor's in insolvency, then you still can potentially get relief. Or if the debtor company issues shares by way of settlement of that debt, and the companies become connected because of that issue of shares. If they're already connected, this won't help you. But if they only come connected because of the issue of those shares, you can still have your relief. So that's just very briefly about connected persons, etc., etc. What I wanted to talk about now are some of the anti-avoidance rules. These are can be quite nasty, I think it'd be fair to say. I'm not having to go at HMRC. I just think you can inadvertently get caught here. They have introduced certain relaxations to be careful here. Sections 361 and 362 of the loan relationship rules in CTA 2009. So 361 is perhaps intellectually the easy one to think about. Well, it is for me. Where a company is or becomes connected with a debtor and acquires impaired debt. So we'll have a look at an example in a minute. There, the debtor company, the borrowing company, has a deemed release, so it has to bring taxable income potentially. So that's where you acquire the debt from a connected party. There's the other situation where there's a borrowing, the parties are unconnected, but they become connected. What's all this driving at? Well, this links back to the point we were just talking about. Possibly the best way is to illustrate this by way of an example. So Helen has given us this example. New Grosh Limited borrows 10 million from the bank, but I'm in a lot of trouble. I'm likely to default. But New Grosh's parent, Kanxula, acquires the debt for £8 million. So the bank, it's lent on the commercial terms. Unfortunately, it's had to take a haircut of £2 million. It's going to claim tax relief on that, and I think we'd all agree that's entirely fair. But now the debt's been acquired by a connected party. And what the legislation doesn't like is the fact if we were to subsequently to waive that debt, we would ignore that waiver for tax purposes. So the revenue have given £2 million of tax relief, but they don't get a clawback here. So what happens is that New Grosh Limited has a deemed release of £2 million when that debt is acquired, which one might say is a little bit harsh insofar as, I'm in financial difficulty. Well, hold that thought. There are a couple of exceptions. One is Kanxula Limited issues shares to the bank by way of consideration. And it's pretty unlikely, isn't it, in all honesty, that a bank's going to take shares in your company. We do hear of it occasionally, but that's just...
It was in the Credit Crunch. I did
the
see
good old Credit
my
Crunch,
favourite
yeah.
Credit Crunch.
Our old friend. And the other is the corporate rescue exemption. So the loan's acquired on arm's length terms. The debt is released within 60 days of it being acquired by the connected person. It's reasonable to assume the buyer would have been insolvent within 12 months, is in financial difficulty. And you may recognise the corporate rescue exemption. There's a mirroring provision in section 322, condition E, that deals with the waiver of debts. So this is purely a waiver of a debt from a third party. When does the borrower not have to bring in a credit if it's in financial difficulty? So one of the questions I would ask, though, and this is often overlooked, okay, we've had a clawback of £2 million. What if New Grosh Limited turns himself around, Helen New Grosh gives him a good slapping, and he's able to repay that £10 million? So Kanxula's paid £8 million for the debt, and it's received £10 million. It's made a £2 million profit. That £2 million is taxable. From New Grosh's perspective, it's got a corresponding £2 million loss on this, because it's had to pay £10 million to get rid of an £8 million debt. So there's symmetry there within the group. So from the revenues perspective, they're quite happy with that, because the banks had £2 million of tax relief, and New Grosh Limited has this section 361 charge of £2 million on the acquisition of the debt, assuming neither the corporate rescue or the debt for equity exception applies. Section 362, as I say, personally, I see this less often, but that may just be luck or otherwise. So Finchley Limited owes £500,000 to an unrelated part company, Tallyho Limited. Finchley Limited is sadly struggling, and Tallyho quite correctly makes a prudent view that it should impair the debt to £200,000. And likewise, it's all arm's length, it's all to do with the trade. It claims £300,000 of tax relief. But Tallyho thinks it can turn around Finchley Limited and it buys the shares. So this is now a connected party debt. They weren't connected before, we've become connected. Again, we have a deemed release of £300,000 because of the same mischief that HMRC perceive. People have tried to get around these rules. There is section 363A, I think, which is a fairly general anti-avoidance rule that basically says if you try and get around it and we don't like it, we'll stop you anyhow. And this is not an area where you can go for a non-statutory ruling on. We've tried and the Revenue won't have it. Anything to do with anti-avoidance, they won't give you an opinion on. So just be aware that even if you think of something clever, you might still be caught. And similarly for 362, there is the mirroring corporate rescue exemption if the loan's waived within 60 days of acquisition. And Finchley Limited, in our case here, is in financial difficulty as defined, balance sheet insolvent, or there's a material risk it will be unable to pay its debts within 12 months, isn't it, Helena?
Yeah.
So just be aware of those. They can be, as I say, quite nasty, and we have seen them missed. Finally, and I'm afraid we've not got time to cover this in any detail, just wanted to flag up the unallowable purposes test, which I think is section 440, isn't it, Helena, of CTA? Mm-hmm. This is a rule that broadly says if you take out a loan and we, HMRC, don't accept that the loan's been taken out for bona fide commercial purposes, then we're not going to allow you tax relief if you impair or write off that debt. And HMRC have had some success through the courts on this. It's pretty broad reaching. It talks about things done otherwise than for genuine commercial purposes, or along those lines, isn't it, Helena, is the phrase. Yeah. They have just updated their manuals on this, and Helena's flagged up example 17, so that gives you a flavour for how many examples there are. This is the thrust of the example is you have company A and company B that are owned by family members but not in a group, and company A makes a loan to company B and then tries to write off that loan, and the Revenue are broadly saying, careful son, we might well disallow you tax relief even though they are not connected as defined for the loan relationship rules. If the loan has only been made because of that family relationship, then we ain't giving you tax relief. And it's a little subjective, isn't it? But you know, certainly in those cases you'd want to you'd want to try and document the reason you've made the loan, etc., etc. If it's on commercial terms. I'm always nervous when there's loans made interest free, because to me it's very hard to justify that's for the benefit of the trade, and it's for the benefit of the lender here, isn't it? Yes, it may be the borrower needs the money, that's right, and that would make sense, but to me, if you've made a loan that's interest free, then I think you might be struggling. We also need to be careful, again, we're going a bit off piste here and running out of time, but where you waive a loan between two companies that are not in a group but have common shareholders, this can also be a deemed distribution. Perhaps one for another topic and webinar. So case law is continuing to evolve there, but do be careful, as I say, notwithstanding you may have gone through all the connection tests, etc., and convinced yourself you're entitled to the relief, the Revenue can still throw this pretty broad anti-avoidance rule at you. And finally, as it were, as far as general topics go, well, one quick one after this, the anti-hybrid rules. Again, this is a huge area of legislation, relatively new, relatively misunderstood or ignored. But these rules can apply where you have financial instruments, hybrid entities, dual resident companies, or arrangements involving branches and PEs where we're creating a mismatch. So, for example, this is particularly relevant, for example, where you're part of a US group and the US has its check the box elections. It may treat an entity as see-through, whereas we treat it as a corporate entity. And that can create mismatches. Similarly, we may have a debt instrument that we treat as debt, but the recipient entity or the other side to this party treats it as equity. And these rules are designed to getting a double deduction or a tax mismatch because of these differences in recognition.
I mean, they are very problematic. I mean, you really have to properly understand all your income flows, and you know, you can have to bring in adjustments from higher up the tree and
Exactly. And as I say, we've certainly seen
rules.
it of late where we're part of a US group, you do need to look at this because, and I think it goes back to a lot of what you said about the corporate interest restrictions. You know, we can no longer look at the UK in isolation.
No.
We need to understand the group, and we need to understand what instruments, how overseas entities have been recognised in the group, what recharges there are between the entities, is there a potential for a mismatch there? And there are certain disclosure requirements required on the tax return as well. So just to flag that up, if we're brave, maybe we'll cover that in a future webinar, but watch this space. And the final point we just wanted to flag up again, when we're talking about interest, of course, we need to be careful about withholding tax. Broadly, it applies to yearly interest on loans that are capable of existing for more than a year in broad terms, interest paid to individuals, interest paid to overseas entities, etc., etc. It can also bite under the so-called funding bond rules, where your interest and capital, you may say, well, here's some shares in full and final settlement of what we owe you, including the interest. It's a very odd rule, isn't it, Helena? You can end up having to give over part of the shares to HMRC, or you can sort of pay over the net to the lending company and give HMRC the cash, which is typically how we see it. But there is that provision in there which says you might have to give HMRC the shares. I'm sure you're all aware that you might want to have a look at the double tax treaty to see if a lower rate of withholding tax is applied, in many cases 0. Be aware, now we're out of the EU interest directive has gone, which did provide for groups a 0% rate of withholding tax as well. Can't rely on that.
It's usually worthwhile just kind of pointing out that as well, some tax regimes, they will require you get the maximum double tax relief that can be claimed is based on the treaty rate. So you really are best off trying to see whether you can negotiate the rate down.
Yep. And as we said, there's also the treaty passport that can help in these circumstances. And one point we saw recently, don't think, well, okay, you know, I'll suffer the 20% if the UK is the recipient of income in this case, even though the treaty rate is low, and I'll just claim the 20% against my corporation tax liability on, say, royalty income or similar. Again, we're going slightly off direction here, but the point is you will only get relief in the UK for the lowest amount provided under the treaty, so sort of not optional. Again, there are exceptions to these rules, be it deeply discounted securities. That always amazes me, well, it still works, but it does. And the more sort of technical exceptions, quoted Eurobonds, qualifying placement rules that can be they're only appropriate for much sort of larger, more formal borrowings, as it were, because they do come at a cost and there are complexities. But again, that's something we can potentially cover in a future webinar. So that's it. Thank you all for your time. Thank you for listening. We will, as I say, circulate the slides afterwards. If you've any comments or queries, do feel free to drop us an email. If you'd like assistance in this particular area, we would be happy to help. That's us. I'm the one on the left. It's quite a good picture of me, I think, Helena. It's about as good as it gets. It's just amazing what they can do with Photoshop these days, isn't it? But we'll be back in the future. Likewise, if you've any topics that you'd like us to cover on these webinars, do let us know. I think the plan is, and I'm looking at our wonderful assistant, David, who sits in the background and does all the work here, but I can see him. I think we said we do R&D on the next one, didn't we, David? David's nodding, but thank you, David, for all of your help as well. But thank you for listening, and we'll see you all again soon. But thank you to Helena as well. Cheers, Helena. Bye now.